Next week, Bank of Uganda will be selling off 4 treasury bonds on March 18th, and this is going to be the first auction since the war in Iran and the impacting its impact to the Gulf state is starting to be felt. Now, for those of you who might have read my article yesterday about how this war is shaping the foreign currency exchange of the UGX to the dollar, you might have noticed how right now the Ugandan shilling is depreciating significantly against the dollar, that in the last 1 week it has lost almost 5% ground. And it's time for us to look at how it's impacting the financial markets now. The fact that there is an auction coming up next week where Bank of Uganda and the government are planning to raise close to 1.4 trillion UGX in this auction. The fact that in the last few months, in the last few years, we have seen a significant amount of institutional investors, especially from Dubai, coming to invest in the Ugandan treasury bonds. Then you start to pay attention to the impact of that to the country. Because of the war, that geopolitical tension that has put the whole of Middle East at a standstill, there is pressure of institutional investors. One, my assessment, not making any move of investing because they don't know how long the war is going to be sustained, how long it's going to be there when we shall be experiencing peace. But two, there is always, in terms of such pressures of wars, there is always a move to the safe haven investments, withdrawal of capital, sale of assets in riskier emerging economies like Uganda to safe havens. And that we are starting to see it priced in the treasury bond. Now, when you pay attention to this is the 25-year bond that is going to be sold off next week by Bank of Uganda. It was last auctioned off in November 2025. And since January 2026, it has been on downward trend. Its yield curve has been coming down. You can see in on 9th Feb 2026, its yield curve was its cutoff yield in the secondary market was 16.81%, and it started to calm down. By 17th Feb, we were at 16.5%. That's a 30 basis point reduction. By Feb 26th, 2025, we were at 16.35%. That is almost 50 basis point reduction. Then we ended up reaching 16.1, and we are staying at 16.1 pricing for the most of early March until last week when the war came to life and the whole Gulf Stream and the Middle East came to the standstill. And now what we are starting to see is a pricing. And this is not only to Uganda, actually. I was reading a report in South Africa and they are saying there is a significant sell-off of their treasury bonds by international institutional investors. That comes always with a risk, especially when your local domestic treasury bonds and is always held by foreigners. You always have that risk of pressured sell-off in such times. The good thing with Uganda, our domestic debt is just 90% of 90% of it is held by local institutions or local retail investors. Only around 10% is held by international institutional investors. But the position here is that since the war began, you are seeing an upward trend. The green is back. Last week by March 5th, 2026, we were back at 16.5%. By today, we are back to 16.775%, which was last seen almost a month ago. And this is contradicting because it's coming at a time when Bank of Uganda was pushing to see interest rates in the treasury bond coming down. It's about to raise close to 1.4 trillion. It was banking on the success they had in Feb. In Feb, the 20-year bond brought in a cutoff yield of 15.49%. That was really good for them. Not so good for the investors who always chase the better yields, but that was really good for them. Now, for Uganda, the pressure is on. the yields are coming back. Now, this week we are going to see the same way we are seeing the pressure in the FX, is the way we are seeing it in the domestic money market, in the domestic market, and the returns and the yields are starting to have an upward tick. The more the war is sustained, the more it will create pressure for the government to raise money locally, for the investors to demand a higher premium for the money they are investing, but also the significant impact means is trade is going to reduce significantly, not significantly, but there's going to be an impact to the government's trade, to the country's trade, and that automatically impacts the taxes. If you are not exporting as much as you are exporting, a country like Dubai, United Arab Emirates, it's our biggest FX trader. It's our biggest exporter. We actually exported almost uh, to United Arab Emirates the same amount value in 2025 as the next 8 countries. That's how impactful this war is, especially the way it's disrupting the United Arab Emirates. So when you think about it from that angle, then you know this war is going to impact our economy in one way or the other. It's just that the people who are managing the economy are still in denial. When we look at the 15-year bond, which will be auctioned off also next week. You know, um, it was last auctioned off in Jan, and when it was last auctioned off, it came in at 16.45%. Since then, it was also on the downward trend. You can see in for the greater part of 2025, and in December it was within 17.7. Then in Jan, after the election, it dropped from 17.2 to 15.4%. That is close to 200 basis point reduction. After that, it is sustained it between 15 and 15.5. Now, since the war began, you can see it's now on upward trend from as low as 15.3% to now back to 16.5, and that means all the investors are pricing that in and also demanding a higher premium to investing and holding the treasury bonds of the country, or there is a pressure especially by the international investors, institutional investors, to sell off their assets in such risky economies at a time when there is significant FX, at a time when there is significant FX depreciation of the UGX, that is always priced in on the losses they're going to make if they continue holding these volatile assets in countries like Uganda, like in Kenya, like in South Africa. So it's happening. The impact to the war is here. Now, depending on how you want to look at this, if you look at it as an investor, it means next week's auction might be a blessing in disguise. It means you might make significant amount of money than what we had anticipated. It means we might get better yields. If the secondary market is demanding a 16.5 on the yield curve, and then it comes back in the next week when the 15-year bond has a 16.5, would have won, because before the election there was no way the 15-year bond would have come back at 16.5. It would have been below 15.49% as its cutoff yield. Its best benchmarked bond is the 20-year bond, the 2043-year bond, which in Feb brought in a 15.49%. Now, if a 20-year bond can bring in a 15.49%, then you have to ask yourself how much rate would the 15-year bond, which is short term, would have brought in? Maybe 15.2. Now, for the war, it's giving us an opportunity for us to make money. For us to make money. So next week's auction, it has a risk. It might not be like that, and maybe between now and next week things might change, and the economy gets better. The Bank of Uganda put some shockers to the economy not to be disrupted heavily by the war, or the war might de-escalate and the countries everything opens up. For now, what we are seeing, the economy is coming, the return is there, it's time to make money. No matter how you look at it, those two bonds that are coming next week in the auction, whatever the results would have been before the war, that has completely changed. And as you can see on the upward trend.